Hi, this is Ed Mysogland. I'm the Indiana Business Advisors managing partner, and today I'm looking so forward to being with you and to discussing how the 5 steps to a happy exit from your business. And we spend a lot of time talking about valuation and that side of of an exit. And in this webinar, we want to talk a little bit more about why you're exiting and how you're going to exit and transfer methods for exiting. And so that's what today's webinar is about. So I hope that you get a lot of takeaways from it. Now, a couple housekeeping things. First, if any of you have any questions, you're certainly welcome to put it into the chat. Chelsea from our office is manning that and will field any kind of questions. There were a number of questions that we'll address at the end that came in from from the original email. If for whatever reason technology is not favorable for you today, Chelsea will be sending out a, um, a copy of not only our slides, but a link to the webinar itself, as well as a white paper talking about all the same things that we're talking about here. Okay, so why don't we get started? So there's two questions that you have to ask yourself before you exit. Number one, is the business ready to sell? And we use a service called the Value Builder system. That's one of the many tools that we use in our shop. And what that does, and we've talked about it on previous webinars, it evaluates your 8 key value drivers to determine, is your business ready to sell? And if when you're dealing with a buyer, what's the likelihood that that buyer is going to, where are they going to attack your business? Where are the chinks in the armor? And the Value Builder system does that. And then obviously we do other valuation work and price positioning and target marketing and things to that effect in order to evaluate, what's best for your business. The Value Builder system is a complementary thing that we have historically always offered. Um, Chelsea will have a link in the follow-up email if you wish to take it, if you haven't already done so. Okay, the second thing is, are you personally ready to exit? And that's a different animal. And you would think that it's an easy one, that I'm done with the business, especially on days that I have to make payroll. But you would be surprised at how many business owners have identified themselves with their business and not understanding what life is post business is problematic. Now, there was recently a study that Pepperdine uh, did, in which they evaluated why do deals fall apart. 40% is value gap, meaning that there's a difference between the price someone's offering versus the price that the seller wants. The second thing is 40% is allocated to emotional reasons. Why people, you know, like I was saying, why don't they want to sell? What is pushing, what is pulling them to sell their business? And then the other 20% is just weird things happen in deals and just unforeseen problems. So again, 40% is value, 40% is, are you personally ready to exit, and and those kinds of situations. And then the last thing is 20% you just can't foresee. So that's what we're going to do today. We're going to talk about the 5-step exit checklist that'll help you identify, is now the time to sell your business. Okay, so step one, um, we have to get a clear understanding of why you're exiting. So there are push and pull factors. Um, in most cases, there's a combination of factors that are either pushing you away from your business or are pulling you to something. So push factors are these. And this is by no means a comprehensive list, but certainly we're seeing a lot of COVID related push factors, like I'm not certain I can do this anymore. I'm not certain I can withstand any more kind of adversity. Those are push factors. So here, has the market peaked? You know, do you need to diversify? You know, is all your personal net worth tied up in the business? And likely it is. Is it time to retire? Does health force a sale? Are you bored with the business? And stress. And so those are factors that push you out of the business. Now here are some of the pull factors. So you want to get into charitable giving. You want to, and then this we put start a foundation, but you know, do you want to work at your church or a non-for-profit? Do you want to start giving back? You know, is there another business that you're interested in going into? Believe it or not, I recently read a study that more people over the age of 50 are getting into new businesses, meaning they're starting businesses or buying businesses. You know, do you want to travel? And you know, or perhaps do you want to get fit? Now, these pulling factors, and we'll talk a little bit about it later, but you know, these are things that you have to consider is what does your life look like after you sell the business? You know, do you really want to play golf every day? So after the first 30 days, do you really want to keep playing golf every day? Do you want to, you know, do you want to travel the world? Well, okay, that there's nothing wrong with that, but my point is, you know, you have to come up with a reason that's pulling you out of the business. And I'm I'm part of the Exit Planning Institute here in Indiana, and one of the studies that they did was 75% of people who sell their business are not happy having sold their business a year later. And so that's a staggering statistic. Now, I can tell you that after the 2,100 companies that we've sold, I have not heard too many people complaining about selling, but or you know, regretting selling. But I do know that through networking and such that this does happen. That the business, you know, it's hard to think of life outside of the business. Okay, so next, so make a list of what you are excited to do. That's the first thing you need to do, and you probably want to bring on your wife and other invested parties. You know, that certainly your spouse or your, like I said, your wife or husband. You want to bring them into the fold, and you want to, because you guys are going to be spending a lot of time together. Um, it's funny. In fact, two after 30 years, I think I've hired two people that were former clients on the sell side, and they, you know, their wives, they had their little partial retirement, and the wives are like, I want you out of here, and they actually came to work for us. So this is you know, make a list of what you want to do or excited to do. So now step two. So we need to align your exit type with your why. All right, so you have a number of exit options. Your first one is to sell outright, and that's what, as a brokerage, you know, our shop, that's what we do. We help companies sell, and we help them sell to. We confidentially expose their business to the marketplace, and there's different types of buyers, and we've talked about this in previous webinars, where you know, it depends on who the buyer is. You could have somebody that is looking to buy themselves a job. You have strategic buyers. You have private equity groups. So your exit options are, first, to sell outright. Two, recapitalization. Recapitalization is probably for larger businesses, but what that means is, and it's called a recap. You have your business, and you have the target, the business that's doing the acquiring. They have a strike price, and what happens here is that they start a new entity and they recapitalize it with the assets. Okay, the assets from you as the seller, and 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 the assets from the new entity, and it's a fractional interest. And what we typically see, it's roughly 20 to 30% that the seller retains that stock in the new entity. And the intent behind it is when you have a large company buying your company, they then can turn around, improve it, and then turn around and sell it. And then you've heard the term the second bite of the apple. Well, that's what that means, that 20 or 30% that you have left in the new entity, when it gets sold, you get that second bite of the apple. Okay, you can liquidate. Um, Liquidation is I recently on the Defenders of Business Value podcast, I had Matt Gallivan from Gallivan Auctioneers and Appraisers, and one of the things we talked about was liquidation as an exit strategy. And there's a number of people that we both have worked with that their sellers have said, look, they're going to carry me out of this place. Well, that's okay. If your family understands that that's your wishes, then God bless you, and away you go. And at the end, it's a liquidation. So that is a immediate sale kind of thing, where an auctioneer type company will come in and facilitate an orderly liquidation. You can hire someone. You can hire a chief operating officer or CEO. You yourself can serve as a chairman, and again have a chief operating officer under you, and you can facilitate that. Gradually reduce your visibility in the business and allow someone else to run it for you. And I mentioned our podcast, The Defenders of Business Value. One of the things that continues to, after all the episodes that we've done, it continues to pop up, is that the two biggest issues are, one, how not to be the business, meaning you, the business owner, how not to be the business, and number two, how to best care for your people. Your value is in your people. So those are the two areas that limit your visibility, but again, you can maximize your value that way. You can transfer it to your kids. Once again, back to the podcast, we had Tom Deans from Every Family's Business, and transferring to the kids is another excellent way to get out of the business, so long as your kids want the business. And then last, management buyout. That can be either fractional interest or an ESOP. And then one of these days we'll talk about ESOPs, because it does take a special type of scenario in order to make that work. Okay, so as I said, let me get to my notes here. So what you now need to do is align your reasons to sell with your exit options. So I'll just go through a couple of these. You obviously can read. So if you want to retire, you can sell to a strategic or third party, or you can transfer the kids. Okay. If it's peaked, you want to sell to a strategic buyer, somebody that's able to take your business and capitalize on the market, and then turn around and sell it again. If you're just interested in taking chips off the table through this risk aversion, that's fine. You can do a recapitalization. But again, you got to remember, not every business, this does not apply to everyone. If you're bored and just want out from under it, liquidation. Like I said, I don't want to say we're seeing a lot of liquidation these days, but I do know that there is a lot of activity in wanting to do an orderly liquidation. If you're just looking for something to do, these are excellent ways. These are excellent transfer channels. You can slowly diversify your visibility in the company through hiring. You can sell to a strategic, or you can liquidate. Now, if health is the matter, you've got obviously you need to get out from underneath the business. And so you have liquidate, you can sell to a third party or transfer the kids or sell to your employees. And again, I'm sorry, I'm remiss in telling you that as part of what we do, we have this consultation with you. We talk about, what is the best option for you to maximize the value. And so we want to, before we go to market, we want to make sure that we're aligned with you on what it is you're trying to accomplish in the sale, other than I just want a bucket of money. That's not always the case. So we spend an awful lot of time on the front end just trying to understand and come alongside of you to ensure that we are going down the same path with clear understanding. Because what we do know is that confused buyers don't buy, and if we can't explain the motivation behind the sale, then we have challenges. Okay, moving on to step 3. We got to figure out your number. We have a number of questions at the end about valuation, and so I do want to talk a little bit about 3 ways that you can come up with your number. So you have to understand what it's worth versus what you need or want for it. As I indicated before, that Pepperdine University study that I referenced, I mean, there's 40% of the time it's a value gap. So what you need versus what you want is a challenge, because what we find is often they're not synonymous. In fact, I can tell you the majority of time that they're not. And I recently had Brian Trzynski from Mass Mutual on the podcast, and we were talking about the income replacement value. And I'll one of our next webinars we'll be talking about that, where you can see how you can back into your number based on your lifestyle. But from our standpoint, again, we're about preparation. When we go to the market, we want to make sure that we understand everything about that business, especially when we're talking about value, because the numbers have to work. And just because you need or want something does not necessarily mean that it's going to happen. So if you need to evaluate your retirement strategy, well, that's fine. Or if you need to talk about how are we going to reduce the value gap, that's fine too. We have a value growth services in the shop, and we're happy to, like I said, come alongside you and help you increase the value of the company. Okay, so number 1, retirement. So if you need the income you need to fund your lifestyle is $100,000 a year. That we put 25 years as your retirement, and so you need $2.5 million in order to live that lifestyle. And again, this is, I'm roughing this out. I mean, there's all a financial planner would fall over in their seat if they saw what I was doing. But what we're trying to do is at least get you thinking what you need. So, and then from there you deduct, what are your investments outside of your business? Where is your net worth tied up? Is it in homes? Is it in retirement accounts and such? Back that out, and then so now you know what the net proceeds are needed from your business sale, and in this case it's $1.8 million. If you're bored or something else, let's take a look at the number of years you've been running the company. So you have a market rate compensation. What does it take for you to run your company based on market rates? Now, as an appraiser, I can tell you I use a couple different tools. The one I would suggest, if you want to see what you're worth in the market, you can go to salary.com and put in your what you do, your industry, and what your role is, and it should give you an idea of what you're worth. Now, certainly I would use the median, not necessarily the high or the low, but I would use in the middle as a guide. And so from there, you would then back out what you're actually being paid. And so now you have, what's your investment of time? And in this case, it's $80,000. So you deduct the 120 from the 200,000, and then you multiply it by by 7. So this is the total value of time invested in your company. Now, let's talk about how to calculate the net proceeds of the sale. Let's just say you have a sale price of 3.5 million. You have a brokerage fee of 260,000. And again, these are just rough numbers. You have legal and accounting fees that run between 2 and 4%. If you're going to, offer any kind of, thank yous to your employees, which, some people do, we just roughed that out at, roughly 10%. And, some are uh, doing charitable giving through through the sale of the business. Let me see. And so that leaves you net proceeds before tax of 2.8 million. So you deduct from the 3.5 million the brokerage fee, the advisor fees, and any kind of thank yous to get your net proceeds, and then you put in your tax. And in this case, we have 562,000, which is 20% of that net proceeds, and that leaves you 2.2 million dollars. Now, as I was saying, part of what we want to do, and we're not tax accountants by any means, but we certainly will rough out some idea of the tax consequences. It's sometimes we do that. Most of the time we say, what, here's what we believe the value of the company is. We need to go to your accountant and figure out, what are some potential tax consequences for that. You can do it on the front end, but what we don't want to do is have a big surprise at the end. You also have to consider how you're going to receive the value of your company. Are you going to receive it in cash? You're going to receive it in stock. I can tell you that 90% of the time that in our practice, we don't do a lot of stock sales. In fact, it's very few and far between that, and we're not licensed stockbrokers either. We never set out to facilitate a stock sale. Sometimes it just happens where the attorneys get together and they determine that there's enough reason and benefit to warrant a stock sale, and at that point, the attorneys take care of it, and we step aside. But the purpose of this slide is, which would you rather have? Would you rather have cash, or would you rather have stock? I think for a lot of people, it depends is the normal answer. So would you take stock in a company that you believe is going to take your company to the moon? Yeah, you might. 65%, I don't know about that. But at any rate, that's what you need to consider is, what are you willing to do? And again, it may take to getting into the process to figure that out. Okay, so this is 6 things every employee, and when I say employee, that means you should negotiate as part of the sale. And again, we tend to do this. First is and we come alongside you and work with you and your advisors on what is your role post acquisition. So first thing is job description. And before I get too much further into it, this is negotiated. I mean, some people are saying, oh my gosh, if I knew I was going to go work for somebody, I wouldn't have sold. Well, there needs to be some sort of transition. And that, we've seen it, go as short as 2 weeks, and for some, they exceed into, a year or more. But what we do need to know is we need to evaluate what it is you're going to do and for how much. So, like I said, first thing, job description. What's your role? Number 2, your compensation. Number 3 is, are there any options? How are you incented to be participatory? Number 3, if you get fired, what happens? How about vacation? Are you going to receive any kind of perks for doing so? And then what happens if the company that bought you gets acquired? So these are the the six things that you need to consider. Now, obviously, all of this is negotiable as part of the sale process. There is some level of expectation that there is a transition that goes along um, with the sale of the company. Now, if it exceeds an orderly transition and you're becoming an employee, that's when this kicks in. All right, step 4, decide the life you want after the exit. Okay, so do you want to serve as the lender? So if someone gives you, say, it's 5 million versus a downstroke of 4 million plus 8% interest on the balance over 5 years, that picks you up another $216,000. Does that appeal to you? Now, everybody we talk to, every seller is like, there's no way that I'm doing seller financing. And most of the time it's a nominal amount that that's required, but there usually is some sort of um, mandatory seller financing because there's just inherent risk in small business, and you as the seller are not providing audited financial statements. You're not providing any kind of assurance about your business. And in order for the buyer to have some level of uh, mitigating their risk, they have to have a vehicle to offset that in order to keep your attention if something's wrong. Okay, how about an earnout? An earnout is if then financing. If something happens, I'm willing to pay you X. A lot of deals happen this way, especially when there is transfer of books of business. So you have $5 million cash, or you have $3 million in the downstroke and $6 million potentially on the earnout. So would that induce you? Now, that's a viable option, but again, it may take some time to get to that balance. So the question becomes, do you have that kind of runway to wait for a potential $6 million? Is it better to take 5 million cash or 3 million on the downstroke and 6 million as a potential earnout? So what's your role? $5 million in cash, or take 4 million, 8, and then serve as a consultant over the next few years and get a consulting fee. That's a viable option. Again, but only you can answer that. This recapitalization, $5 million now, and if you remember how I described the recapitalization earlier, there's a downstroke of $3 million, and they go and sell their company. They increase the value, and you pick up another $7 million. Again, you got to trust who you're getting in bed with, but there's potential for a considerable upside. Does that make sense for you? As a shareholder, you get $3 million of cash. Oh, I'm sorry. Nope, I had double slide. Sorry about that. And then step 5, pinpoint your spot on the exit matrix. So if you look over here, you want to maximize cash proceeds of the sale. And on this axis, you have your willingness to stay during a transition. So to sell to a strategic, you get the best of both worlds. You get maximum value, and you likely don't have to stay. So that is sell to a strategic or third party. Come on. Obviously, when you liquidate, your value, that's probably your lowest value. Again, but you don't have to stay with the business. One day you own the assets, the next day you don't. Out here is recapitalization we talked about. You're going to have to go along with the ride for a little bit, but you probably are going to maximize the value. Management buyout, again, you're going to have to hang around, but your value is probably not necessarily strategic value, so to speak, but it's certainly higher than liquidation, a little lower than strategic. You can transfer the kids. Again, there may be all kinds of advanced tax planning that can make this advantageous, but again, you're probably not going to get all your cash at once. So the value is again a little bit higher than liquidation, but not much higher, and you're going to have to stay. And again, there's no right or wrong answer. These are just things you need to think about. And then lastly, if you're going to serve as chairman, I mean, this is more you're going to get value for the company, but you're going to have to stay and get it, and you're going to continue to serve in a capacity for which the income stream is probably superior to receiving a maximum value for the company. Okay, so let's go back through these. So number one, the 5 steps to get ready to exit are you got to get a handle on why you're exiting. Number 2, you have to think about the type of exit, and does it align with your why? Why are you exiting? Number 3, we have to figure out your number. So again, we'll help you in that, in guiding you with the value. And number 4, decide what kind of life you want post exit. And then number 5, you saw that exit, you saw the exit matrix. Where do you fit on there? Now let me see a couple questions here. Okay. All right. Now these are the questions that we received. So how do you determine and defend your price? Okay. This is everyone's challenge. How do you determine and defend your price? Any valuation, and it doesn't matter what kind of asset that you're appraising, it's based on earnings, so your earnings, your expectations, and risk. So how do you determine and defend your price? Well, the first thing you have to determine is your earnings. How are just because you believe these are all your earnings, and I'll give you a rough example that we had a client that had $30,000 worth of a failed, or what he felt is an ineffective marketing campaign. So there's $30,000 in this marketing initiative, and he felt that we should add it to the earnings stream. And my argument was, well, did you receive any revenue from it? Well, yeah, we did. It just wasn't as profitable. Okay, well, I can't either. We have to back out the revenue, which will reduce your value, or we have to back out the cash. We can back it out of the cash flow. So my point is, how do you defend it? Number one, you have to have a solid earnings analysis. You have to be able to explain why this number, the earnings, will be able to pay myself, pay any kind of debt, and get a return of and on my investment. The second thing is expectations. What does your company look like? Can you do any forecasting? What is it? Especially in this environment, there's a lot of volatility going on now. Knock on wood, there hasn't been a lot of volatility as far as value suppression, but generally speaking, if you can't see, the long term, what this business looks like in 3 to 5 years, that's problematic. And then lastly is risk. So when we look at risk, what is the risk to you as the investor, and what is the risk to you as the investor, and what is the risk to the business? Where, when I say risk, when we look at the business, where is the risk coming from? From from the overall economy, or is it supply chain? Is it people? Is it customers? Is it where's the risk there? So when you ask how do you determine and to defend your price, I mean, obviously we do a lot of value work, but you have to be able to defend why it is the way it is. And I know that seems kind of hokey, but you have to make the numbers work. People just are not they're really risk adverse right now, and they have to have a clear understanding of the business in order to to give you the price you want. And so you have to be sensitive to that, and certainly we're happy to come alongside you and help you there. So what's the process of valuation for a service-based business? Well, it depends what kind of service is to begin with. Every business has tangible and intangible assets. So this service-based business is predominantly intangible assets. And the challenge becomes, okay, what's the likelihood that those intangible assets will follow the seller, or will follow the buyer after the seller completes the acquisition? That's the tough part. So not knowing what the service-based business is, this is the challenge. So I'm going to just kind of give you a macro overview, and then you can whoever asked this question, you can reach back out to me, and I'll be happy to dive a little bit deeper. So the process is like everyone. We go through analysis of earnings. We do market-based research. We do industry-based research. We evaluate it for risk, and then we determine a value. The biggest thing for us is, again, when we look at the services, we have to look at the risk inherent with the service. Like, for example, an accounting firm has a different level of risk than a janitorial firm, or a manufacturer's rep business. We had a number of those come through the door, here in the last couple of years, where these guys have made a small fortune, over the years, and now they want to sell their companies. Well, you have a 30-day cancellation of their contract. So how can we best do that for them? Because that buyer has to, who's going to give you $500,000 in this case, for your business, when in fact in 30 days it can evaporate. So I hope that explains that. How would you value an owner managed restaurant? Like any other asset. I mean, again, it's back to the same thing. What are your earnings? What is the risk inherent to the business? Now, in food and beverage right now, in the hospitality world, you got a lot of businesses got beat up. At the same time, a lot of the companies a lot of the hospitality related businesses that we're working with are thriving because they were able to make the pivot, and are doing a ton of carry out and capitalizing on this environment as opposed to getting beat up. So we have to evaluate the risk, and then we have to look at what's the likelihood that the value, or can we forecast what this thing looks like a few years from now? So again, it's back to earnings. Can I pay when you're talking about a restaurant? You have to be in a position to understand how best are you going to be able to transfer that asset to someone else. Again, just because you're owner managed, I mean, everyone wants to, I shouldn't say everyone. There are a lot of people that want to own and operate a food and beverage business. What they fail to understand is the complexity associated with it. It sounds really good to have my buddies over to my bar, and we can watch the game on Sunday. It's not, like I said, most people fail to understand just the level of complexity it takes to run that type of business. So how would you value it? I would value it the same way I indicated it before, but as far as how we would sell it, you would have to be real sensitive to having someone that has the horsepower to run it the way an owner operator would. It's one thing if you have a manager in place, then you're buying the investment. When you have an owner, it's an entirely different animal. All right, what price should I be asking for? That's a tough one. I don't know enough about the what business we're talking about, but the price you should be asking for is probably a little bit above the value. Everybody wants to negotiate. I guess that's probably the price you should start with. And at the same time, and be prepared that you may have to negotiate based on the price. All right, so what is the process to acquire an SBA loan for the purchaser? Well, good news. I'll give you the overview, but the good news for you is on Thursday, we have our available for acquisition webinar. And my good buddy from Live Oak Bank, John Randall, who I've known for 20 years, he's a fixture in the lending community. He'll be on with me to guide you through that. But generally speaking, you find the business, you have an offer, buyer seller agree to price, terms, and conditions. Financial due diligence is completed. Application is made to the bank, the preferred lender. The preferred vendor comes back with their letter of intent to loan, and it has various conditions that they need met in order to do that. And then from there, it's very similar to our process where we're removing contingencies. You're now removing contingencies for the loan for the or removing contingencies in order to close the loan. Now, people ask, what are those contingencies? One, it may be life insurance. Two, business valuation, environmental studies, legal documentation, lease, assignment, things like that. And then once all of that's done, then the SBA issues a loan number, and the bank is free to distribute funds. So now let me see what else. And then when is the right time to sell? I did a podcast on this not too long ago because we get this question a lot. So the couple things that I would share is, if you stop investing in your company, that's probably a good indication. If your health is starting to deteriorate, it's probably the right time. If you look out at the horizon of the balance of your life or retirement, you need to understand that this process takes time. So let's just plan at minimum an 18-month ride before you're totally done. Not necessarily our service, but when you start transitions and things like that, do you have that kind of runway remaining? And then lastly, I think you need to evaluate, like we were talking about, what are you going to do? I mean, there is absolutely nothing with running your business until someone has to carry you out. There is nothing wrong with that. Just as long as everybody in that knows and loves you are on board with that and they understand it. So, this is more of just a planning thing. So when is the right time to sell? Right now, I can tell you from a brokerage standpoint, it's a real favorable time. I'm not making the pitch that you need to show up at our doorstep, but I am telling you from a lending standpoint, I mean, it is surreal what is going on in the SBA and the availability of capital right now. So I think that's the first thing is access to capital. So that having that access to capital would be an opportune time for you to maximize the net proceeds. So you'll probably get more cash today than say if the economy 180s on us, then unfortunately a lot of sellers end up having to serve as the bank because lending's tight. I would also offer that you know there's a lot of businesses that are going to come on the market over the course of the next decade or so. It just depends on where do you fit. I can tell you that with unemployment the way it is, there's a lot of buyers that are out there that are looking for new jobs, and they receive severance packages. There's favorable lending out there. Those are all really, really good reasons to consider selling. And like I said, if you go to defendersbusinessvalue.com, you can find the podcast where I did a little bit more of a deep dive on the right time to sell. All right, so let me get to this last slide. Again, here's my contact information. If I can help you in any way, we are more than happy to do so. For the value builder assessment, even though this URL is a little longer, it will be a link in our email, follow-up email from here. And then I want to again remind you that we have our available for acquisition webinar on Thursday from 12 to 1. And what does that mean? We are featuring a number of our businesses, and I'll be interviewing some of our brokers about just some of the favorable attributes of each of these businesses and why it's a good investment right now. So I hope you have enjoyed this webinar. And like I said, we have an open shop. We've been doing this for 40 years, and we're going to keep doing it. And I think we've managed to have such a favorable reputation in the community by being generous with our information. So if we can help in any way, certainly let us know. All right. Well, thanks so much for your time today. And again, if I can help or any of us can help, just let us know. Thanks so much. We'll see you next time.